Hello, and welcome to today's Rystad Energy Oilfield Service webinar, reviewing the last 9 months and examining how the outlook for the service market has been changed by $75 oil. My name is Matthew Allen, and I am a representative of sales and marketing at Rystad Energy, and will be the moderator for this webinar. Our webinars run as part of our frequent industry insights around upstream, oilfield services, shale, market, and renewable solutions. We offer various industry newsletters, as well as information sessions, webinars, and similar types of events, which we invite you to sign up to if you haven't already done so. So keep an eye on your inbox or visit our webpage for upcoming events and for newsletter sign up. Today I have Joe Friedman, our analyst from the oilfield service team at Rystad Energy. He will share with you the latest trends and developments in the oilfield service market. We will now commence with the presentation. On your webinar window, you are able to see a chat box where you're welcome to raise any questions you may have during or after the course of this webinar. We will respond to each of the questions following the webinar. The presentation will last approximately 30 minutes. And with that, I now hand you over to Joe.
Thank you, Matt. So for today's agenda, I was planning to talk about how the oil price of 75 has changed the outlook for the service market. Then after that, we're going to look at where we expect the investments to be going in 2018 and forward. And in the end, look if there's any dark clouds hanging over the service market going forward. So in September, October last year, the Brent oil price was around 55 USD. But much has happened since then, and yesterday was trading at 75, today around 74. So what this chart is showing is the development in costs and also the free cash flow for all the E&P companies. And we can see the dramatic drop in costs from 2014 to 2016, and we now see how the free cash flow for the oil companies has started to increase. And by looking at the scenario for 2018, how the free cash flow develops in a 55 oil price scenario and a 75, we see it's a quite dramatic change. It's almost a 30% increase in free cash flow. However, the cost is only marginally increasing. So this means that the oil companies are earning more money. Some of this will be spent on dividends to the investors, but this gives more money for future investments. And this will, of course, drive activity going forward. This next slide shows the latest projects that have reached final investment decisions. So this is between 2013 and 2018, and we see that the shale has had a massive reduction in break-even prices and is now down in the 50s, and the average payback time is actually around approximately 1 year. But just to make clear, this is the average Brent oil price that the E&P required, so the wellhead break-even price for VTI is more down in the 40s. And with lower risk related to short payback time, this makes shale a very attractive investment choice. Break-even for the latest projects reaching FID of offshore is now even lower than for shale. This is one reason is a compression in unit prices, but even more importantly is largely due to downsizing and re-engineering. So one example is Shell's Vito project that was sanctioned now in April. It has been a successful cost reduction of almost 70% compared to the initial cost estimate back in 2015. And this is largely due to a simplification of platform design and also downsizing. The same goes for the Mad Dog Phase 2 project in the Gulf of Mexico, a similar story, choosing a standardized semi-submersible platform instead of a more expensive spar platform, and managing to cut costs by approximately 60%. Here we see that we are on track to sanction over 90 offshore projects in 2018. In May, 39 project was sanctioned, and we have already seen some large sanction project in June, for example, Johan Castberg field in Norway. So we are on a track to see a lot more project being sanctioned this year compared to 2017. And that we can also see here that sanctioning activity has rebounded. In 2017, we already saw a rebound, and that was largely driven by subsea tieback solutions. So even though subsea tiebacks are usually have more limited resource potential, these investments use existing infrastructure and makes the investment smaller, but also the payback time shorter. So that was leading the comeback in 2017. But then we see around 38 projects being sanctioned, more projects being sanctioned in 2018, and also an uptick in 2019. And what is quite interesting is if you look at the same chart, just looking at how much offshore greenfield capex that have been committed for the different years, we see that the increase in capex committed is much larger in percentage than the unit count of projects being sanctioned. So you see the only 2 more projects being sanctioned, expected to be sanctioned in 2019. The increase in greenfield capex is much larger. So what this means is that we now are seeing or are expecting more large developments to be sanctioned in this year and next year, and especially a comeback in deepwater projects. So, and out of the 17 deepwater projects that has been approved over the past 18 months, as many as 16 has previously been developed but put on hold due to the industry down cycle. But now cost has come down and break-evens has come down, and they are now expected to be sanctioned this year and next year. And just to illustrate this, we see that more than 70% of the future commitments have break-even prices below $60 per barrel. So even if oil prices would go down in 2018, a lot of these projects will likely go through. So the next topic is where we see the investments going. And what this chart is showing is that the year-on-year change in capex, and we see that the shale investment had a huge growth in 2017, almost up 60%, and we expect shale to increase also in this year and also in 2019. When it comes to offshore, it's expected to bottom out this year, and then have an increase in 2019. But it's not, since the unit prices are going down in a lot of the offshore markets still, it's not given that the activity will go down. It's just that the E&Ps are getting more value for the buck, and more activity and still low prices is one of the reasons for this. So where is E&P investments going to be largest for the next 5 years? We see that the United States is dominating, especially with the shale investments, and then followed by Russia and China with more onshore conventional oil, and then Canada. If we just look at the largest offshore regions, we expect activity to pick up in Brazil after some very difficult years. So Brazil is one of the largest offshore regions going forward. Also, Norway has seen a lot of new FIDs lately, and we expect a lot of investments towards 2022, and then followed by United States and United Kingdom. Just to kind of illustrate where the activity will be happening, we see the Golden Triangle with more activity in Brazil, Gulf of Mexico, and West Africa, but also with some new regions like Guyana with the lease development. Yesterday, Exxon also had their 8th oil discovery in that region, so it's an interesting new offshore region, going to be important going forward. We see a lot of these subsea tiebacks is concentrated in Europe, in the UK, and in Norway. and then we see a kind of a spread all over the world with new projects. So this matrix shows how we expect OFS purchases to grow or decline in different regions and by different service segments. So the overall picture here is that towards 2021 we see positive growth in all of the service segments, and but there's some differences here between region and between the service segments. So just to highlight some of these, we see in the well service industry, which is largely driven by shale, and we see a strong increase here in North America shale, and also actually in offshore in North America. We expect activity to pick up in Mexico, for example, around 2020-2021. So also a large positive growth here. Europe, on the other hand, for well services, we see actually a little bit more lower growth compared to other regions. It's been low exploration efforts in Europe or in the main regions in Europe for many years, and a lack of new large field discoveries. And it's usually more of these smaller tieback solutions that I've talked about. And we see here for the subsea market is quite a strong growth in OFS purchases. Also in Asia, we see strong growth, growing from a much smaller base. But in India, for example, we have some large project with our cluster series, for example. When it comes to the rig companies, especially for offshore, we've seen that the rates for the drilling units haven't picked up much yet, and we also expect those to be low for the next couple of years, especially some markets. But we expect an increase in activity, so that's mainly driven by activity compared to unit prices. Okay, so are there any dark clouds hanging over the service market? Unfortunately, there are some, and I'm going to talk about some of them. And I'm going to start out to talk about the subsea market. So here you see the development for revenues for the top 8 subsea suppliers. And it has been a downward trend since 2014. And from last year, it's a 9% decrease in revenues. So the service market, the subsea market usually have a seasonal effect due to harsh environment, the harsh environment market share in Q1. So we actually expect that Q1 2018 is going to be the low point in terms of revenues, and over the overall growth in 2018 is expected to be a 2% growth. However, there are some gray clouds that have yet to clear, and that is especially when we look at the margins. So we see here that the margins are down 6% from Q1 2017 to Q1 2018. So it's evident that the high margin projects that was agreed upon prior to the downturn, they have been finalized, and the low margin projects that have been awarded in 2015 and onwards are currently being executed. So just to give one example, is for example Subsea 7, one of the market share winners in the SURF market during the downturn, and they have been very successful in capturing new contracts. So by comparing their UK projects, for example Western Isles and Catcher, and compare it to the contract value for example for Penguins, we see that by looking at this from a kind of a simplistic view, but taking the contract value and looking at how many million USD per kilometer surf line, we see that it has dropped quite a lot. It's now for Penguins down to around 2 million. So even though this is a simplistic way of looking at it, it still shows a downward trend in the industry. And since the execution and the majority of the payment on a project like Penguins will occur in 2020 and 2021, it's also evident the margin will continue to be depressed for several years going forward. Then I'm going to talk more about the drilling companies, and this chart here shows the Rystad Energy Oilfield Service Index by award year. And what we can see here is that we actually started to see service inflation onshore in 2017, while offshore is falls the third year in a row. And one of the reasons for this is the prices going down for the drilling contractors. And it has been a very difficult market in the down cycle. Here we are just looking at floaters, so semi-submersible and drill ships, and the utilization levels, and they have gone down from in 2014 they were around 80-90%, and it's all down to the 50s. We've already seen a comeback actually in mid-water harsh environment units, where there's been a lot of new contracts coming in, so their utilization has picked up. And the other markets is looks a little bit more challenging. And one of the reasons for that is that the first thing is when we look at scrapping, the market is very oversupplied, and for the drill ship market, which had a lot of new deliveries lately or in the downturn as well, we have seen not too much scrapping going on. So utilization levels haven't improved much based on scrapping. It's a little bit better in the semi-sub market. And another point is that we still see very short contract duration compared to what we saw in the high days. So, for example, in the Gulf of Mexico, which is kind of lagging behind the other regions in terms of long-term contracts, one reason for that is that majors such as Shell and BP, they have an oversupply of rigs on contract, so they use those rigs, while other smaller operators are mostly contracting on a well-to-well basis, and here you typically get a lower rate. So one example is the rig West Neptune that had a long-term contract that ended in December 2017. The rate was around 573,000 USD per day. Then when the contract ended, the same operator recontracted the rig to drill development wells for one of the projects, and then the day rate ended up being at 155,000 USD per day, and this represents a cost cut of around 73%, which is extreme. And the same story goes for one of the most important floating markets, namely Brazil. At the beginning of 2018, there was around 23 rigs on contract. 80% of these had prior contract that was around average of 5 years and an average rate around 400,000 USD per day. By the end of the year, 10 of these rigs are expected to go off contract, and the demand is higher, so they will need to rehire. In Brazil, there will be new contracts coming in, and then we expect the rates to be lower than the average 400 that was before. Then this chart shows the quarterly how the quarter-to-quarter change in revenue by different service segments. And the one I'm going to focus on now is well services and commodities, which has had a positive quarter-on-quarter growth through the whole 2017, and then we saw actually revenues, negative change in revenues in 2018 or the first quarter. So the question is why? Why is this happening? And this market is very dependent on shale activity. And one reason for this negative trend is that the completed well count in the US has slumped in Q1 2018 compared to the fourth quarter 2017. And this is due to industry-wide supply chain challenges, leading to increased drilled but uncompleted wells. And this is what you can see here in this chart, that the completion activity has been lagging behind the recovery in rig count. So basically the service industry have a problem delivering on the demand due to various bottlenecks. For example, for the propane supply, there's an issue with trucking and road infrastructure. Another issue, for example, for the pressure pumping industry is that they're currently operating at maximum capacity. There's also an overall labor shortage with a lack of experienced people in the majority of the service segments. So Rystad Energy will have an own webinar around these topics on June 27th, mostly focusing on the Permian. So for a more in-depth session on this, please join in. And I think this is my last slide, so I will leave it over to Matt.
Thank you for listening in, and thank you, Joe, for giving this fantastic review of the oilfield service market. With this, we conclude today's webinar. If you would like a more in-depth product demonstration, please don't hesitate to contact us, and one of our sales team will be in touch. Once again, thank you for attending. We will stay online for a few minutes should any of you have any questions that you wish to write in. Thank you.